Job order costing system is what we're going to talk about. And we're going to look, first of all, generally, what's the purpose of cost accounting? What's it all about? Then, what is a job order cost system? And how do those costs attach themselves to the product, if you will? The flow of costs on that shop floor. How are they accumulated and assigned to each product? Then we're going to look at how we do that. We use what's called a job cost sheet. Okay. And then we introduce the concept of predetermined overhead rate. You see, there's no problem tracing the material that went into the manufacturer of my desk, the direct material. There's no problem tracing the direct labor that went into my desk. The problem is, how do I assign all the indirect manufacturing costs to my product? And I do that with what's called a predetermined overhead rate. And actually, it's an estimate. And as all estimates are, we're either going to be high or we're going to be low, which means we either under-applied our overhead to the product or we over-applied it. Okay, so that today is going to be the length of this lecture pretty well. Cost accounting systems, all the systems now, are designed to measure, record, and report product costs, costs on the shop floor. That's all we're talking about. And it's not a separate system from the financial accounting system you are already working on. Cash, accounts receivable, prepaid insurance, all of that is your general ledger accounts, asset accounts, liabilities, revenue, expense. A cost accounting system only requires the introduction of a couple of accounts right in your general ledger. So don't think of this as a complete separate set of accounting records. It isn't. It's integrated as part of your general ledger. We only add a few more accounts. And as I said before, we're dealing with 3 inventories. But the main inventory that we're working with is work in process inventory, and it's on a perpetual inventory system. So that's the cost accumulation systems. Now they mirror the type of operations I have. And basically, there are 2 types. A job order cost system, which we're going to spend a lot of time on, and a process costing system, which we'll introduce later. Okay, but we'll talk about it now. So there are 2 types, basic types. Now some companies are completely job, some companies are completely process, some companies are part job and part process. All right? So now, on your phones, sign in. There'll be prizes for the winner at the end. Good, 24 players. I want to see 40. All right, 30 is pretty good. All right, first quiz question. The major purpose of cost accounting is to, I'm talking too loud because I think I'm talking to Elaine. Am I talking too loud? Is to what? Measure, record, and report, period, classified all costs. Classify all costs as operating and non-operating. Measure, report, product costs. Right. 13. No, we don't measure period costs. That's why I showed you the separation, the office from the shop floor. So it's product costs. All right. Now, we're going to talk about a job order costing system. Now, this system assigns costs to the product, a desk, all right, that I'm going to manufacture right up here, or a batch 100 desks for Abu Dhabi U. Okay? So we define the job as an individual desk or a group of desks, but we're always going to be talking basically about an individual. So we assign these costs to each job or batch, which is a number. The key feature here, I'm a desk manufacturer, I manufacture this desk. It has certain characteristics. It's this big, it's that high, it has so much wood, it has so much metal. Now the next job I do would also be a desk, but it will be different. Different size, different amount of wood, different amount of metal. And that's the key thing about a job costing system. Each job has different characteristics. Okay, they have direct material, they have direct labor, but they have different amounts of direct material, direct labor. And they accumulate a different amount of overhead. But my objective here is to compute the cost per job. All right, so I measure the cost of each job complete. That's what I'm doing. I'm measuring the cost of the jobs that I complete on the work in process on the shop floor. For example, I'm a printing job. And in comes a job, and that job is wedding invitations. Okay. And there are going to be 225 envelopes. They want a particular kind of stock. They want particular ink. They want the typesetting. And they want 225 of them. I give that job a number, 9501. Then in comes a job from a local restaurant. Wants us to print up menus. And so the menu has to be certain size. Different stock, yellow stock, color ink, 50 copies of this, and laminated. So you see different material, all right, different size, different, and it's given a job number, 9502. So my job now is to calculate, or not to calculate, accumulate the cost of doing this job and try to be as accurate as possible because I'm going to sell this job. I want to make sure I sell it for more than it cost me. That's the nature of business. And this one over here, I'm going to accumulate that cost too instead of selling price. Now, marketing normally sets a selling price, 100% markup, you've heard that, on costs. So it's essential that I get these costs right. Because based on those costs, they set the selling price. If the costs are wrong, then the selling price is going to be either too much or too little or what have you. We wouldn't be competitive. So cost is so important to get the cost of the product. All right, so that is a job order costing system. Now, contrast that to what's called a process cost accounting system. It's used when there's a known volume of similar products. All right, now if we're in LA and I use the Coca-Cola plant, your Coca-Cola here is produced in LA. And the Coca-Cola plant produces it in a process. They start off with water, they add sugar, color, they boil it, they do this, they do that, and what have you. And then they package it at the end. But you see, every can of Coke has exactly the same amount of material, exactly the same amount of labor. All right, so what I do here is I accumulate the cost for the whole process for a week, let's say, and then I divide it through by the number of cans of Coke I produced that week, and I get the unit cost to produce a can of Coke. Now, of course, in this country, it's petroleum. All right? Petroleum is produced in a process, so think of that. And for the period, we accumulate the cost for that period. And then we divide it through by number of barrel of oil. Now, just as an aside, you are cost accountants, I think I will be designing a course next spring called Accounting for Oil and Gas. And guess what it's going to be all about? Process costing. So it's going to be an elective. So if you're interested, watch for it. But here you see, I assign the cost not to the job, but to the process. And then I divide the total cost, direct material, direct labor, and overhead, I assign to the process for a week, and I divide that by the output of the process. But each unit of output has the same amount of material, the same amount of labor, and the same amount of overhead. So we do this through that. And here's an example, and I use oil. The whole process to produce DVD discs follows this same. The oil, the benzene is removed, that's part of the process, so the cost of removing that, the cost of developing the pellets and smashing those pellets, and then the cost of pressing them into CD discs. Each CD disc has the same amount of material, the same amount of content. So I would accumulate for the week the whole cost of production for that week and divide it through by that number of discs. Any question? Now, I used Coca-Cola as a flow, and I'm using petroleum. Well, don't just get the idea that it's flow stuff. Take a look at your computers, your Dell computers. Every Dell computer has exactly the same amount of material, the same amount of labor. So you see, these computers, if I was accumulating the cost to produce these computers, I would use a process costing system. I would accumulate it as a process. I would look at all the material and say, okay, for a week, how many? I'm going to accumulate all the material, all the labor, all the overhead for a week and say, okay, how many computers did we finish this week? And how many are still partially completed? That's a flow process. So process costing just doesn't mean liquid. It means that we're producing a product in which that product, each product has exactly the same amount of direct material, direct labor, and overhead. Now, there are some plants, like when I first came here, I did some work at the Emirates Date Factory. I actually have a film on it, I should show it to you. Everybody been there? Well, it's very interesting. You want a cost accounting system, you walk in there, and of course, they process the dates. You clean them, they fumigate them, and then they take the pits out. And that stops. Now, some of that goes over here, where they cook the dates and they put them in these big things and they make syrup and juice. So you see, if you were going to accumulate the cost of making the juice or the syrup, it would be a process cost. You process the dates all the way through. The other side of the plant, they have dates that are the dates where they put in almonds. There's chocolate dates, and they make these baskets that they sell to their suppliers, the different stores. So the stores put in orders, we want baskets like this size, that's job cost. And part of that process there are dates for the military. And they were all on a pallet there. And there were boxes. Each box had the same amount of dates and the same size and everything else. So you see, that part of the process, that part of cost accumulation is process costing. So here we have a company that is job costing in part of it. I want to accumulate the cost as accurately as I can. So I have to understand the process and accumulate the cost according to that. And on the other side, one side is job costing, the other side is process costing. So there, in Canada, I worked at Firestone Steel. And of course, there was a part of the plant, they don't do it anymore, where they processed the rubber. And then the other part, they fabricated the tires based on the different sizes, different orders, stuff. So it's process costing part and job costing the other part. So I'm only giving you that to explain that most companies would either be job or process, but many companies too, or some companies are a combination of both. And if you're doing cost accounting, you would have to say, okay, I am going to accumulate the cost over here over a time period because the output is the same. So I can accumulate the costs as over a time period, direct material, direct labor, and overhead for a week, and then divide it through by the amount produced, gallons or whatever. And over here, I need to accumulate the cost of producing certain baskets of dates. So then each job is a number of baskets, okay? So each job basket is different and the dates are different, and some are with almonds in it, some are chocolate. Okay, you got an idea of what I'm talking about? 2 types. All right. All right, get your phones. You should still be signed in, right? Which of the following would be accounted for using a job order costing system? Production of personal computers, refining of oil, or the construction of a campus building? This is job costing. Right. Not the production of personal computers. I went through that example when I talked about Dell. Okay? So you got to identify these. Question 3. An important feature of a job order cost system is that each job has its own distinguishing characteristics. Each job must be similar to the previous one, or must be completed before the new job is started. Yeah, 20 of you got that right. 6. Gotta go back to read this again. I'm recording this, so we'll make sure you go over that again. Process costing is used when products is aimed at filling a specific customer order. Costs are to be assigned to specific jobs, or the production process is continuous. And the answer, of course, is 3. Yeah. All right. Now, I'm going to zero in, and for the rest of the class, it's going to be job order costing. And what I'm trying to do is, remember the picture I showed you at the beginning, the shop floor? 3 inventories, raw material, finished goods, not well. It's the work in process is where the cost accounting system is operating. And so manufacturing costs are going to be assigned to WIP. When that is finished, when the job is finished, it's not going to get any more material, not more labor, no more overhead. It moves to finished goods. All right. Then it sits in finished goods as an asset. Keep in mind, these are assets. They're not expenses. They don't become expensive until they're sold. So the inventory is sold, it becomes the cost of goods sold. That's what we talked about last class. That's what you did with your cost of goods manufacturing statements that we went through. Okay. Now, if you want to visualize it in the records, this is how it looked like. I have my accounts over here, manufacturing costs, material, labor, and overhead. And we assign these costs to work in process. Direct material, direct labor, manufacturing overhead. I debit the work in process. Increase the value of the work in process inventory. I decrease the raw material inventory. So I credit raw materials and I debit work in process. I have the direct labor as factory labor expense. Well, it's not an expense, it's part of the asset. So I credit that expense and I debit work in process. And then I have the overhead, which I accumulate as debits, the actual amount of overhead. And when I assign the overhead to the work in process, I credit manufacturing overhead. And I told you that in your general ledger accounts, you're going to have the job costing system only means that we add one cost to our general ledger system, one account, and that's manufacturing overhead. All right, so it's not a separate accounting system, as I said before. It's integrated. Now, when I complete the product, I credit work in process, I debit finished goods. Since in finished goods, when I sell it, credit finished goods and debit work in process. That's how the costs flow through the cost accounting system or through the general ledger system. How do I accumulate the costs? Each cost is a separate job. Each cost has a separate number. So I create what's called a job cost sheet. And this sheet is going to keep track of the material, labor, and the overhead assigned, and follow the job through the shop floor. What that sheet actually is a subsidiary ledger of the work in process inventory. What do I mean by that? Well, you recall in your financial accounting, in your general ledger, I don't know if you went to this that far, in your general ledger you had accounts receivable. But then in your subsidiary ledger, it read 100,000. Then you also had a subsidiary ledger. Did you work with them? Which accounted for everybody who owed you money and how much they owed. They had a card for everybody who owed you money. That box with the cards of all the people added up to the general ledger. The general ledger said there's 100,000. Here is a box of cards of the people who owe me money, and that adds up to 100,000. You also had a general ledger for accounts payable. Did they teach you subsidiary ledgers? In your general ledger, you had accounts payable 50,000. But you also had another ledger called a subsidiary ledger in which you listed all the suppliers you owed. And when you added that up, it equaled the accounts payable. And when somebody paid, you took them out and you reduced the accounts payable. Okay, did you learn that system? That's called a subsidiary ledger system. So I have a general work in process account in my accounting ledger. In my accounting records, I have work in process. On the shop floor, there are 4 jobs. And there are 4 job sheets. And you'll see that if I total the cost on those 4 job sheets, if I did everything right, it will equal the cost in the work in process. So that's what they mean by each job sheet is a subsidiary ledger. Every entry to the work in process inventory must be accounted by a corresponding posting to the job cost sheets. And we will demonstrate this. I just want you to keep that in mind. All right. There's your job cost sheet. So, job number 101. Item, desk for Abu Dhabi University. Number 1 could be item, desk for Abu Dhabi University, quantity 1,000. It's still the same job. Okay? For Abu Dhabi University, date started, requested as soon as possible. The date, record. Anytime somebody works on this job and gets material for the job, if it's direct material, they record it here. All right? Then they work on the job, cut the sheet and do stuff like that. They record their time, their labor. So I'm accumulating the cost of material that went into this job. I'm accumulating the direct labor that went into this job. And then we'll talk about the manufacturing overhead after. Okay, so I summarize those down here. There's your 3 cost elements: direct material, direct labor, manufacturing overhead. Total cost divided through by the number of units produced. And that's the number of units requested in that job. Any questions to that point? Yes, I have some right now. Job cost sheet constitutes a subsidiary ledger for the goods inventory, work in process inventory, for the cost of manufacture. I don't know why you think the others. Most of you got that right. Okay. The flow of cost in a job order costing system accumulates manufacturing costs incurred and assigning the accumulated cost of work done. Measures costs, product costs for a set period of time. That's not job order. Generally follows LIFO. So the answer, yeah, it's not this one. Measuring product cost for a set period of time. That's a process costing system. It measures product costs for a period, but a job order cost system has nothing to do with time. Okay, any questions? Number 7, the two major steps in the flow of costs. What are we actually doing? We're allocating and assigning. We're acquiring and accumulating. Or we're accumulating and assigning. Okay. Very good. I want to make sure you understand the words here. Assigning means I assign costs to the job, right? Allocating means I accumulate a lot of costs and I give a portion here and a portion there and a portion there. It's like your birthday cake. You got your birthday cake, you're going to allocate it. So much to the little ones, some bigger pieces to the bigger ones, and so on. That's allocation. All right. Now, assigning, when the guy takes wood, starts the job, I assign the cost of wood to that job. I assign the labor to that job, but I have to allocate the overhead to that job. All right. So that's allocating and assigning? No. Acquiring and accumulating? You understand accumulating? No, what we're talking about is accumulating the costs and assigning them to the job. All right? Are we clear in the language? Good. Because some of the problem is just the definition of these terms. All right. I'm going to start off with raw material. Notice the heading, assigning manufacturing costs to WIP. What's the first cost category? Raw material. Where's the raw material? In raw material inventory. And what we're going to do here is assign to the job the materials that are issued. And how do I do that? I have what's called a material requisition slip. Requisition means I require. So if I require something, I fill out a requisition slip. Materials. And it's written to authorize the stock control guy in raw materials to release the materials to the production guy. Now what materials? Well, most of the materials will be direct materials like wood and laminate and metal. But some of it may be glue. Well, you know the difference between direct and indirect. If it's direct material, I can measure exactly, then it goes to direct material again. But if it's glue, it has to be accumulated in an account called a manufacturing overhead. It's indirect. I, therefore, debit the manufacturing overhead account. So here's what a requisition slip would look like. It's simple, it's nothing. It just says, okay, listen, I'm doing delivered to the assembly department, job number 101, work in process. so many pieces of wood, so many pieces of metal, so many pieces of glue, what have you. He requisitioned it, this guy approved it, and it was released. That's all it is. So you see, this card will be signed and kept by the store, the guy who handles raw material inventory. Okay? And now, recorded on job 101 will be the direct material cost transferred from there to there. So on 101, you'll have direct material costs. So that's how, there, okay. So how do we record this? You're up in the accounting area. Okay? So this company uses 24,000, they're going to say for a month, 24,000 of direct materials during the month of January. That's what came out of raw material, 24,000. But they also had 6,000 indirect material, glue, nuts, bolts, what have you. So all of that came out of raw material. I credit raw materials. But I go to my work in process account and I debit for direct material, the 24,000. And I go to this new account called manufacturing overhead and I debit it. So it increases. So the journal entry is simply that. Debit, work in process, debit manufacturing overhead, and credit raw materials. And it's posted here, and there's already 13 in manufacturing overhead, so another 6. So you see, we're going to accumulate the actual manufacturing costs on the debit side of the manufacturing overhead account. And that's how I handle raw material. And of course, that 24,000 would have went to job 101, 102, 103. I'll show you that later. No, I'll show it to you now. Here's the general ledger, a debit to work in process. Here are the 3 jobs on the floor, 101, 102, 103, and this is for a period of January. Job 101, the 6th of January, there was 1,000. The 12th of January, 7,000. 64. So there's 12,000 of that 24 went to job 101. 7,000 of that 24 went to job 102. So that's 19,000. The other 5,000 went to job 103, and there's the dates. You see, these are the subsidiary ledgers. They add up to the 24,000 in the accounting department. This is sitting in the accounting department like all the other accounting records. This is following the jobs on the job floor. Wherever job 101 is, there's the sheet. Wherever job 102 is, there's a sheet. That's the subsidiary ledger. At all times, we know what's going on the floor. Okay, so that's material. And the second one is direct labor. And of course, I accumulated those. And they're assigned to job based on time tickets. Now, everybody has time tickets now. You can see the doctors at Tulum come in and they have to punch time clocks. How many people here punch time clocks? Nobody? Oh. Anyway, if you're working on a production and you're a production employee, you'd have a time card, and we know how much we pay you. Okay? So on the time card would be the employee, the number, and the amount he charged to the job. So this is what a time card looks like. The employee's name, John Nash. Charged to WIP, work in process. Job 101, do you see that on the right-hand side? And he worked 4 hours and we pay him $10, so it's $40 of direct labor. This is only direct labor. And it goes to job 101. He's not working on all 3. He's working on just one job. Somebody else has a time ticket for job 102 that they're working on in job 103. All right. In the accounting records, well, the same thing again. Let's assume here that we accumulate all the costs of the hourly workers, the direct labor, no, I'm sorry, of all the labor, And all the labor cost was 32,000. Now, most of that was direct labor. That is, the people who actually worked on the job, 28,000. But 4,000 of it was indirect labor, the factory, the forklift guy, the guy who sweeps the floor, the supervisor's salary, or what have you. That would be indirect. The supervisor's salary wouldn't be on a time card, so I get that wrong. Just other people on the floor who don't work directly on the product. And so I know that it's 32,000. Well, that's sitting as a labor expense in my records. It's a debit, factory labor expense. So I credit it because it's not an expense, and I debit the work in process, which is an asset, and the manufacturing overhead. I debit the work in process for the direct costs and the manufacturing overhead for the indirect costs. There you have it. So now I zero out factory labor expense, and I say that 28,000 is the direct labor. So in the work in process account now, inventory account, I have the material and I have the labor. I have 2 of the 3 costs. In the manufacturing overhead, I simply have some more indirect labor costs, which is labor. Are we clear to that point? Do you have a vision of how this all fits together? I know it's a lot. I know it's your first time, but believe me, when we finish, you'll have a good understanding. All right? Again, when I look at the accounting records I have up in the air-conditioned office, I have a work in process accounting. It has 2 debits to it for all the work. It has 28,000 now in labor. And when I go down to the hot shop floor and I look at the job tickets, they would have the same amount, 15,000 now. Of that 28 went to job 101. 9,000 went to job 102 and 4,000 went to job 103. You add that up and you've got your 28,000. So you see you have the exact amount in the accounting office as what's on the shop floor at all times. See, this is a control tool. I know what's going on all the time on the shop floor. Now, those are the first 2 cost categories. The third one is all the indirect manufacturing costs. This, well, let's see. I have a question or not? No. The third cost element is manufacturing overhead. Now, manufacturing overhead are all indirect manufacturing costs, electricity, depreciation on equipment, okay? Indirect, I don't know exactly how much was used for each job. I don't. I haven't got an idea. There's no way I can measure the amount of electricity goes to each job. So I accumulate them in an account called, when I pay Edwea or what have you, I debit manufacturing overhead. I keep an account called manufacturing overhead, which I debit all the time. And this relates to all production operations, because I cannot assign them to the individual job. So what I have to do now is develop, and we do this at the beginning of the year, production year. I develop what's called a predetermined overhead rate. The accountant will take a look at all the indirect costs incurred last year. The rent, total AC, total everything else. All right? And the accountant would then say, all right, I think, at the beginning of the year, he says, I think the total manufacturing overhead for the year, the coming year, will be 1 million euros. So the production, you sit with the production people and you say, okay, production people, you know how many desks you did last year. How many desks do you think you're going to do this year? and they might give you a number, 400,000. Well, I cannot take all that overhead and just give a piece to the 400,000 desks. Why? Because I have at the end of the year some uncompleted desks. So I have to assign it fairly to the whole production. Most of the production is finished, but a portion is not finished. So I can't do it by completed desks. I have to do it by something that is directly related to the production of that desk, which I can measure and be fair. So I can choose one of three things: direct labor hours. Now, if I produce these desks with a lot of direct labor, then a desk that size would take so many hours. A desk bigger than that would take more hours. So the bigger desks should take more overhead. You understand what I'm saying? So we translate the production, 400,000 desks, whatever, what did I say, 40,000 desks? We translate that production into hours. We say, okay, Mr. Production Manager, how many direct labor hours will you require this year? And he'll say 500,000. Okay, I'm not going to steal it. I got $1 million here, 500,000. For every hour worked on that desk, I'm going to allocate. Remember allocate? I'm going to allocate, I'm going to assign that overhead to that desk with the direct labor predetermined overhead rate. I'm going to assign it based on 2 dirhams an hour. So if there's 6 hours in that desk, it picks up 12 dirhams of overhead. If the other desk had 20 hours of direct labor hours in it, it picks up 40. It picks up more of the overhead because it's bigger. And that's fair. You understand? So what I've done is I've estimated at the beginning of the year the whole amount, $1 million. Oops. I estimated $1 million. And I'm going to assign it to the product based on direct labor hours, and I estimated the hours. So I'm doing 2 estimates here. But I'm going to use that 2 dirhams an hour through the whole year for all the production. Or I might be producing something a little more sophisticated in the desk, an electronics part. And the direct labor, some of the direct labor is assembly labor, some of the direct labor are engineering type labor. So you see, I don't want to do hours because these hours over here, I pay them more than these direct labor people over here. So I might use direct labor dollars this time. And I say to the production man, okay, translate that production into direct labor dollars. And he says 200,000. Okay, so I got the million. I divide by 200,000. So for every direct labor dollar that was spent on producing that desk, I'm going to assign 5 dirhams. You understand what I'm saying? Or I might be a completely automated manufacturing plant. Very few direct labor workers, a lot of machines. So if that's the case, we say the production, how many machine hours do you think is going to be required to produce the 40,000 desks? And he says 100,000 machine hours. Well, then I'm going to assign 10. Now, don't get me wrong. Companies don't use all 3. Companies use either direct labor costs or direct labor hours if the labor is basically all the same. Direct labor dollars if the labor is a mix. And machine hours if it's what we call a capital intensive manufacturing process. Capiche? All right, think about that. So I use one of these. But notice what I'm doing. I'm estimating at the beginning of the year. So this is what this sign says. Based on the relationship of the kind of product and the cost, I either use labor or use cost. And in every problem, they will tell you the base is cost, or the base is labor, or the base is machine hours. You won't be asked to figure out what the base is. They have to tell you. So management decides what that base is at the beginning of the year. And notice what it says. Estimated annual overhead costs, $1 million. Divided by estimated annual operating activity. either direct labor hours, direct labor cost, or machine hours. Gives me a predetermined means estimated, overhead rate. But I'm going to apply that overhead rate on the actual number of hours worked for the actual direct labor cost. So I take the annual activity base, I come up with a predetermined overhead rate, and then I look, let's assume it's direct labor cost. Because on my job tickets, I have accumulated the cost of the direct labor for each job. So now I'm going to assign the overhead based on that cost, on the actual cost. It's a predetermined rate, which is an estimate, but it's assigned based on the actual use of the activity base, the denominator. An example, here we have a company, again, same company, Wallace, and they use direct labor cost. Do you see that? It's not hours, it's cost, as the activity base. And they assume the company expects annual overhead to be $280,000. Now that's rent and electricity and supervisor's salary and all those indirect costs. They estimate it to be $250,000. And the direct labor costs, they also estimate to be $350,000. So there's two estimates here. But nevertheless, that's all I can do. I use them. What's the overhead rate? Divide the cost by the activity based. Cost by the direct labor cost. The overhead cost by the direct labor cost. And it's 80%. So that means that for every direct labor dollar worked on these products, and I'm accumulating those on a job sheet, I'm going to assign 80 cents to cover the manufacturing overhead. Okay? And I use that for the whole year. I do not change it. I use it for the whole year. Now, the jobs are finished. Will applies the manufacturing overhead to work in process. So I have direct material and direct labor there. I need the overhead. I look and I see that the direct labor is $28,000 for all three jobs. Therefore, I'm going to assign $22,400 to these three jobs I've been working on. And I make a journal entry. Debit, work in process. You see that? Increase. But notice, credit, manufacturing overhead. Yeah, new account called manufacturing overhead. The debit side is where I accumulate the actual costs. The credit side now is where I apply them, okay, to the products. So that's the manufacturing overhead account. Here we go now. So it's 80%. So now they finish, what actually happens is these cards, they finish. No more material, no more labor. But the guy on the shop floor doesn't know what the overhead is. He has a rough idea. He sends these three cards up to me in the cost accounting system area. I take the three cards. Now, job 101 has direct material, direct labor. I now have to assign overhead to it. How am I going to do it? I apply the 80%, 80 cents. So I take the amount of direct labor and I assign 80% of that to manufacturing overhead. So it had that much direct labor cost, it picks up this amount of the overhead. So this is actual, this is an estimate. But nevertheless, I get the total job cost of $39,000. Accurate estimate. So you see the total cost of my job, it's not exact. I go to the second job card, 102, and I say, okay, this job is finished. How much was it? And I look, it's 9,000, 72. And so therefore I'm going to assign 72, 80% of 9,000. And I get the total cost of that job. I do the same for the third job. Now when I total 39 23, and whatever that one was, 12 or 17, it will equal the total of these three. At all times, this equals this. And now I know the cost and I credit finished good, work in process for the ones that are finished, and I debit finished goods. Bring it up, and I know the cost of them. So now I've got my three cost elements assigned to the product I'm producing. And each product has a different amount of material, different amount of labor. And therefore, each product is going to have a different overhead. Now for overhead. But nevertheless, that's the best I do. So at the end of the month, I reconcile. I say, okay, what's my work in process? 74.4. I total my three jobs, which I just did, 74.4. And I know I got everything correct. Okay. Used. Labor costs that have been identified as indirect labor should be charged to what? Very good. Okay. Manufacturing overhead is applied to each job. Notice the word applied. On always predetermined overhead rate. Not at the end of the year. I don't know what they are. How can I assign costs to the goods I produced in January, the first month of the year? I don't know what the overhead is going to be, actually. The only way we can do this is with the predetermined overhead rate. Predetermined overhead is based on the relationship between estimated annual cost and actual activity, estimated annual cost and expected annual activity, estimated monthly cost and accrued liability. No, not the first one. Not actual, I assign it based on actual activity, but I don't use that in the predetermined overhead rate. Question 11. Predetermined overhead rate is, I know, determined on a Mooney average basis, determined at the beginning of the year, determined at the end of the year. It's not determined as a moving average. I said estimated annual. It's the beginning of the year, and it's used throughout the whole year. All right, so there's my job cost sheet. It comes up to the accounting office. The accountant totals the material, the labor, and assigns the overhead. Comes up with the total value of this. Can't get rid of that sign down there. And I divide it through by the number of units up here, 1,000. And that way I get the unit cost. So I produced this in January. Now that's what it looks like in summary. There's raw materials. That's easy to keep track of because it's perpetual inventory. Direct labor, we have time cards. But look at the manufacturing overhead. The debit, that's a new account in your accounting records. As I said at the beginning, job cost system is not anything separate than the financial accounting system you already have. We just add one more account called manufacturing overhead. And we debit it for actual manufacturing overhead. Okay. And we credit when we apply it to the cost of goods manufactured, work in process. So try and get that overview all on the job cost sheet. All right. Now, as I said, job 101 was 39,000. The material was actual, the labor was actual, but the overhead was an estimate. Actually, two estimates. I estimated the total overhead, million. I estimated the activity level, 200,000. That's how I got the predetermined, 2. I applied it based on the actual direct labor costs, 4 hours, but I determined it based on 2 estimates. So I'm going to be high, I'm going to be low. Not likely I'm going to be right on. And so I use what's this called manufacturing overhead account. Now, when I get a bill for Edwea, and I know it's so much for the factory, 8,000 dirhams, it's utilities expense in my records. But this belongs to work in process. This part of the electricity bill belongs to work in process. So I credit utilities expense and I debit manufacturing overhead for that portion, which is product cost. Okay? Utilities expense sits there as a period cost. Part of that is a product cost. So I reduce the period cost and debit the product cost. So all the time I'm accumulating manufacturing overhead on the debit side. When I apply it to the jobs, I credit manufacturing overhead, okay? And I debit work in process, the third cost element. Now, at the end of the year, I have all the debits on one side and all the credits on the other side. So what do I actually have? I have an account that tells me how much I incurred in manufacturing overhead on the debit side and how much of manufacturing overhead I applied to the jobs on the credit side. If they equaled, then obviously I applied exactly the amount I incurred, but they won't equal. If I have a debit balance, that means I incurred more overhead than I applied, because I subtract the debits from the credits, and if I have a debit balance, I've incurred more overhead than I have applied. Does that make sense? Right, so I have a debit balance. If I have a credit balance, I take my credits and correct my debits, and I have a credit balance, that means I applied too much overhead to all the products that have gone through. Well, the job in January has already been sold. In February, it's all been sold. So what do I do at the end of the year? I can't adjust the jobs, but I have to produce financial records that have the actual manufacturing costs. I have the actual material labor, but I don't have the actual overhead. So I close out. Remember closing entries? If I have a debit balance of 10,000 in that account, I credit that account with 10,000 because zero balance. Remember you close out the records? When I close out the manufacturing account, if it has a debit balance, I credit. It has a debit balance. Why? Because I have incurred more than I applied. The amount I applied has already gone out the door. I sold it. So I'm adjusting my records to actual. So I credit manufacturing overhead to bring it to a zero balance. I close it out at the end here. And I debit the cost of goods sold. Why? Because the cost of goods sold was a little too low through the whole year. I incurred more than I applied. If, on the other hand, I applied more to the products, I applied more overhead to the products than we actually incurred, then I over-applied the overhead to those products. And if I over-applied, I'd have more credits than I have debits. So I want to close that manufacturing overhead. So if I have 15,000 credit balance, I debit manufacturing overhead 15,000, close it out. and I credit the cost of goods sold. I bring the cost of goods sold down by 15,000. As you see, the cost of goods sold had estimates of manufacturing overhead that were too high. I don't know this until the end of the year. At the end of the year, I finally get the bills for Edwina, I finally get all the other bills, and I know what my actual overhead is. Okay? And I compare it to what I applied and I adjust it. That's it. Awesome. Simple, eh? Did you get all that? All right. So that is for cost accounting. There, we've just covered all the problems. So I underapplied overhead. What I do is I close out the overhead account and I reduce, I overapply. I gave it too much. I reduced the cost of goods sold. All right, last two questions. Manufacturing overhead has a credit balance. What does that mean? Credit is applied. Good, good, right on. All right, you're gonna have to know how to do all this. All right, question 13, always a bad thing. At year end, any balance in the manufacturing overhead is generally eliminated by adjusting it, zeroing out, closing it, and charging the difference to the cost of goods sold. Those jobs are gone. All right.